I don't know if this is going to be the run rate going forward. It probably will be, actually. In July, 25% of the government expenditures was for interest payments on the debt. There's not going to be a politician under the sun in DC that's going to tell his constituents we have to cut spending.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Dave Kranzler joins us today. Dave is a precious metals analyst and the author of the Mining Stock Journal and Short Sellers Journal. Now, after years of trading expertise built up on Wall Street, Dave now strives to help people like you and me understand the truth of our financial system and the economy. And we are delighted to have Dave join us here today. It's time to saddle up and silver up for Dave Kranzler. Dave, welcome back to SBTV. How are you doing?
Doing well, thanks. How are you doing?
I'm doing great. I'm doing very well. Thank you for asking. Dave, I want to start off with an article you recently posted on your website, Investment Research Dynamics. It was titled The Housing Market is Crashing, Rate Cuts Won't Help. Can you share some of the key points in this article with us?
Sure. Um, I mean, the primary problem in the housing market for prospective buyers is affordability. I mean, the Fed's money printing and zero interest rate policy, along with all of the funds like BlackRock that have been buying up homes on the market, drove prices to insane levels. And prices, I don't know if they're still there. They may be because incomes are continue to fall, real incomes. Um, the price of a home as a ratio of the average income, middle class income, hit an all time high. And so you had a price bubble that say from when the Fed started, well, really from the COVID era until probably mid to late 2023. You had a price bubble that was the biggest in the history of this country, and it wasn't a volume. It was, in the housing bubble that developed between 2003 and 2008. And it actually started rolling over. A lot of people don't know this, but it actually started rolling over. The volume started rolling over in mid to late 2005. But then you had a volume and a price bubble. But this time, the volumes were never as high as they were back then. So, and so what's happened is because of inflation, real inflation, not the CPI index garbage. What's happened is that the average prospective home buyer just can no longer afford the monthly cost of buying, servicing a mortgage, and maintaining homeownership. Now, I mean, the people. Part of the problem with the market is you've got a logjam because you've got people who were first time buyers who may be interested in doing a move up trade, but they can't afford to do the move up, so they're not selling. And then the move up guys who might want to move into a luxury home, they don't have buyers to buy their home from them. And we're seeing that now. The market has really started to freeze up, especially in a lot of the MSAs, the metropolitan housing markets that were the biggest bubbles. I mean, we're seeing it in Denver. Florida is a disaster right now. Austin's a disaster. I haven't seen the latest numbers from Phoenix and Vegas, but I'm sure it's not faring well there either. Nashville, which was not a big bubble city in the um, the first decade housing bubble of this century, but it was a massive bubble in this latest round, and they're getting hammered also. Listings are soaring and prices are coming down. Um, so what needs to happen is if you're going to align what it costs to buy a home, get a mortgage, service the mortgage, and maintain the monthly cost of ownership, you need a massive price reduction in in the housing stock, in where houses are being offered, existing homes and new homes. The new home builders have been cutting prices pretty quickly, but the average new home is still more expensive than an existing home that's on the market. So interest rates, if anything, are going to slow that corrective process down. Because yeah, if you make the mortgage cheaper, it will bring some potential buyers back into the market, but not enough to really, stimulate the housing market. And we're seeing again for the last 9 to 12 months, existing home sales and actually longer than 12 months, existing home sales and new home sales have been in a pretty steep downtrend. So the volume is declining. And you're not going to fix that by cutting interest rates. And the other problem is, and actually, if the Fed does start cutting interest rates, it's going to re-stimulate even worse inflation. So and right, so there's two components to affordability: what you have to pay to get into a house, along with the cost of servicing the mortgage, and then your ability to do that, your gross and net monthly income. And when inflation takes off, your real income goes down, and you end up spending a lot more money or all your money on non-discretionary items. And that's a trend that we've seen with most households. I would say every household under the top 10% demographic, and maybe even the top 5% demographic, they're now devoting their monthly income to non-discretionary items, and part of that includes the cost of maintaining the home. And so, like I said, rate cuts aren't going to fix that. If anything, that's just going to prolong the problem.
Yeah, I guess because what I'm wondering is, let's say we saw the jobs numbers. It looks like unemployment is starting to go up a bit. Inflation, so called tame. I don't know the definition of what tame really could be, but let's say these people yeah, I mean, let's say these people or people can't maintain the home that they live in because of the way the economy is. Is there enough of a supply of homes that are a bit less pricey for a market that may be having to sell off their oversized home to get into a home that fits their family more?
Well, here's the interesting thing about the numbers is that for the last couple months, they the National Association of Realtors breaks out the monthly numbers by price buckets. So, and I can't remember the exact. It's something like 100,000 and under, 100,000 to 250, 250 to 500, 500 to 750, 750 to a million, and then over a million. I think those are the buckets. I just don't remember off the top of my head. But for the last few months, the only two price buckets where there has been a slight increase in activity month to month and maybe year over year is the two highest price buckets. And in terms of sales volume, they're the least significant, right? Your most significant price bucket range is going to be from 250 to 550 or 500 or whatever, or even maybe even up to 700. All of those price buckets below the 750 to a million price bucket have had their sales volume's been declining. And so it tells you that again illustrates the lack of affordability for the average household and the majority of people who potentially might want to be a first time buyer or a move up buyer.
Right. So possible that we may end up living in a corporate home owned by BlackRock.
Very possible. And there's a couple other issues here. So, the whole narrative has been, both the National Association of Realtors and the Census Bureau, the government, been pushing this narrative that there's lack of inventory, and then just gets echoed in the mainstream financial media. Well, that's total BS. Because if you look at the last new home sales report, home builders are sitting on a 13-month supply of homes based on the current run rate of new home sales. And the new home sales, like I said, are declining. So you've got over a year of inventory just from the new home builders, finished new homes. And home builders notoriously do not list all of their finished inventory, right? Because they want to try and make it look like there's less supply. And the inventory of existing homes is now it's starting to rise very quickly, especially in certain MSAs. I mean, if you look like down in Florida, you've just had a flood of Airbnb properties come on the market, and same thing in a lot of resort cities where you know during COVID, everyone was given free money from the government. Rates went down to zero. A lot of people bought Airbnb properties. Well, now they can't afford to keep them, and per Airbnb's latest earnings report, the rate of their occupancy is starting to hit a wall, and they actually guided lower for the next quarter. So, that's going to make it even harder for a lot of people who have Airbnb properties to hold them. So a lot of them are going to have to put them on the market, and that's just going to compound the growing supply. And if you look at another indication of the growing supply relative to demand, is that in a lot of cities, the existing homes are staying on the market longer, and a very high percentage of them are experiencing price cuts. So, like Denver led the market in June. Something like 56% of all homes that were listed, existing homes, had price cuts. And there's a whole list below that. So say the next 19 cities, I think the lowest number was 30% of the listed homes had price cuts. So that's another indication that, you've got significantly more supply now on the market than there is demand.
If you're enjoying this interview with Dave Kranzler and I, please do consider subscribing to our YouTube channel. And did you know that at Silver Bullion, there are 6 different types of accounts to fit your needs? To find out more, go to www.silverbullion.com.sg, click on the signups tab, and choose from these 6 types of accounts. Or email me, Patrick at silverbullion.com.sg, and I'll help to get you started. I watched this interesting film, or at least part of it, called The Great Taking. I don't know if you had a chance to take a look at it yet. It spoke
I
about
haven't had a chance to. I know about it. I know what it's about.
yeah, I haven't watched the whole thing yet either, but it just in the beginning, in the very beginnings, it spoke about how money creation by the Fed was far outstripping economic growth, and how the transmission mechanism for that money creation into the real economy or economic activity was breaking down. It kind of sounds like what we're talking about here, but Dave, because much of the GDP actually does come from debt, and debt equals politicians asking the Federal Reserve to print more money. When do politicians and these central banks actually see that their practices, their theories, they are really causing an economic breakdown, and maybe even accept some kind of accountability?
When is that going to happen? Never. I mean, if you know, in order to rein in the government spending and debt creation, you have to cut. You have to make cuts. You have to make budget cuts. You have to make spending cuts. There, I mean, defense spending is going parabolic now, and that's probably an area where they could chop the budget in half. You've got entitlements, you know, Medicare, Social Security, things like that, and that's just as big as defense spending. I mean, and now I I don't know if this is going to be the run rate going forward. It probably will be actually. In July, 25% of of the government expenditures was for interest payments on the debt. I mean, and so what has to happen? There's not going to be a politician under the sun in D.C. that's going to tell his constituents, "Hey, we have to cut spending, and part of that is our federal allocation for road maintenance. We're going to have to lower your Social Security payments every month. We're going to have to, cut back Medicare benefits." That's not going to happen. And with the tight grip that the Department of Defense has on the government and Congress, there's no way. I mean, if anything, the defense budget's just going to keep spiraling higher. So, I mean, at some point, you're going to hit a wall and there's going to be a crash. But they can keep kicking that down the road by increasing their spending at an increasing rate. I mean, we're on track based on the numbers through July, and the government fiscal year ends at the end of September. We're on track for a north of $1.8 trillion budget deficit, spending deficit. I like how they call it a budget deficit. No, it's a spending deficit because it's money you spent. And the only way to bridge the gap there is to issue more debt. So that tells you that the Treasury debt outstanding over the last fiscal year will have increased by at least 1.8 trillion.
Yeah, yeah, those numbers don't really sound too good.
I just and if they slow down spending, because if you look at the GDP numbers and the employment numbers, the only source of real growth is coming from government spending. So if they cut back to the degree that they need to cut back to rein in spending to a more responsible level, it's going to collapse the economy. So I just think we're in this death spiral that's going to end in a collapse.
I totally agree there. I mean, I think there's only more and more of us every day who are seeing this, as opposed to, I would say, less and less of us who are seeing this. But anyway, this same film also spoke about how the Fed was influencing the financial markets, and we've long discussed how the markets were disconnected from the true economy, and where the Fed was, even during the time of COVID, they were basically choosing winners and losers. Dave, how dangerous is this when it comes to, let's say, banking or the banking sector? Because we're seeing hundreds of small and regional banks close their doors, and the big banks, they take over.
Well, here's the thing. The reason why you're not hearing about issues, why you're not hearing about liquidity issues or deteriorating asset quality at the big banks is because it doesn't get reported. But that's going on. I mean, the too big to fail banks, they're sitting on a massive amount of leveraged loans that they were, when the private equity bubble finally burst, they were still underwriting deals to finance the takeover, going private transactions or um, leveraged debt syndications to finance, Silicon Valley startups or whatever. And it got to the point where the merry-go-round stopped, and these banks were left holding, you know, hundreds and hundreds of millions of leveraged loans, and a lot of those leveraged loans are non-performing. Most of the big banks, well, all the big banks, I mean, even Goldman now, they have consumer lending, consumer finance operate. Well, banks like J.P. Morgan, et cetera, Citigroup, they've always had credit card and mortgage underwriting, but Goldman started getting into it. So they're sitting on massive amounts of credit card debt that are increasingly going into delinquency and default and non-performing status. Same with auto loans. Um, I mean, there's a reason why Warren Buffett has been unloading his Bank of America stock like there's no tomorrow. He's out of Wells Fargo, and I believe he's also out of I think he sold his U.S. bank position a while ago. And I think he's dumped Wells Fargo a while ago, and now he's unloading Bank of America. There's a reason for that because they have huge exposure not only to mortgages, consumer mortgages, and credit card and auto loans, but also commercial real estate. And all the big banks have that exposure. You're just not hearing about it. And the Fed has been able to keep the financial system liquefied. So, everyone, the media reports about this quantitative tightening where the Fed is shrinking its balance sheet, and it's slowly doing that. But if you look at uh, the M2 measure of money supply has been increasing since October 2023. And the base money supply, they call it the monetary base now. It used to be called MZM. That's been increasing since March of 2023. And that's your most powerful form of money supply because it's immediate use capital. It's coins and currency in circulation, and it's bank reserves. And bank reserves can be leveraged. So, and almost all the growth in the monetary basis come from bank reserves. And I'm not blowing smoke. You can go to the St. Louis Fed database and run these charts. So financial conditions are the easiest that they've been by the Fed's own measure. The financial conditions in the financial system are at their easiest level since right before the Fed started hiking interest rates. And then there's another thing that, I mean, people have been talking about, and it's kind of like gone away because everyone expected the reverse. Well, I didn't, but everyone expected the reverse repo facility to go down to zero by this past spring. Well, it's still around. I think it was at 323 yesterday, 323 billion, but it's down from two. It peaked at 2.3 trillion, so the Fed has been letting that money leak into the financial system and into the markets, and it could keep that money captive in the reverse repo facility by just raising the rate a little bit that it pays. A lot of that money is coming from money market funds came from money market funds, and a lot of the drawdown has been from money market funds because now that interest rates are over 5%, money market funds, mostly confined to buying 12-month or less paper, can now buy government debt and earn 5% plus on their T bills and T notes, and that's what's been funding the government deficit. And then that money ends up in the real economy or the markets. And so there's been so what that money captured in the reverse repo facility was the excess liquidity sloshing around after the Fed dumped over 4 trillion into the system during COVID. And and so now, and the fact that the Fed's been letting it run off like this tells you that they're trying to force liquidity into the system, into the banking system, and it's also they've also needed to finance the government spending deficit. But it's in a sense, I call it like a stealth QE program because you've had $2 trillion worth of liquidity go back into the financial system and the real economy in like less than the last 12 months.
I knew I was going to speak to you today, and I was looking at those two exact charts that you talked about. The balance sheet shaved off about, I think, some true 2 trillion, fairly quickly shaved off about 2 trillion, but yet the money supply, the M2 money supply chart shows more money coming into the system or being printed. So I was just going to ask you, how is it on one hand they're shaving off the balance sheet, but on the other hand, more money is being created?
Because you've got, like I said, well, you had a big injection into the bank reserves back in March, right? So you had that, and then you've had this runoff in the reverse repo facility. I mean, a large part of it's money market funds, but not all of it. It's also banks, and that adds to their reserves, and they can leverage their reserves. In fact, the Fed removed the leverage ratio ceiling during COVID. So theoretically, the banks could leverage them infinitely. I mean, they don't. And there's not enough opportunities for them to do that. I'm sure they would if they could. But yeah, I mean, has the Fed reduced its balance sheet by 2 trillion?
I think it did. It was close to 9, and it's down to almost 7, somewhere around there.
Let me just look here really quickly. Wow, I haven't. That's something I don't look at all the time because just to me, it's 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 not as meaningful as looking at the other liquidity measures. 8.9, 8.9 to 7.2. So yeah, 1.7 trillion. Well, on the other hand, you've had $2 trillion run out of the reverse repo facility, so that offsets the Fed's balance sheet reduction. And then you've had these other lending programs, that bank term funding program, that still has a significant amount. I mean, over 100 billion outstanding, and it's been steady. That tells you the banks who have borrowed that money are probably going to have trouble paying it back.
You think we're going to see eventually that the reverse repo, let's just say, quiet down somewhat, and then we're going to end up seeing the repo start to kick up?
Well, that's a good question. I haven't really thought about that. I don't know what's going to happen with the reverse repo facility was under 300 billion for a few days within the last couple weeks. I don't know how much longer it's going to take for that thing to run off. But you're saying, maybe we're going to start to see banks throw their money into the overnight repo system just for safety, right?
Yeah, or I mean, I think back at that time, I mean, right now you're saying how the Fed is taking care of liquidity, but back then, when liquidity was getting tight, that was when we saw the repo market start to run. So
Oh, right, right, right. I'm sorry, I was going the wrong way on the mechanics of it. Yeah, that was the Fed injecting a ton of liquidity into the system. That started in September 2019. I do think at a point you're probably going to have to see that. And if you still are seeing funds in the reverse repo facility, and all of a sudden the repo facility starts going haywire, that's telling you right there the big banks have a problem, because that's what it told us back then. And I wrote extensively about that. If people want to search on my, the historical articles I've posted, I actually posted my first one about that in late September 2019. And I said back then, this isn't just, you know, the Fed saying, the Fed was saying, oh well, we're just, this is temporary, it's overnight repos. And I said, you know what, overnight repos are going to turn into week-long repos, 2-week repos, month repos, and that's what happened. It's going to get a lot larger, and that's what happened. And then you had the market crash starting in January of 2020.
yeah, I remember you wrote about it, and you helped people like me understand it a bit better. So keep writing. We appreciate it. Uh, Yeah, Dave. Well, I guess we're talking about all of these fiat currencies and intervention, and we recently saw that Japanese yen carry trade sort of dominate the global markets with turmoil. Now, all the Bank of Japan did really was raise rates 0.15% from the already 0.1%. So they were really only at about 0.25%. A small move like this sent such shockwaves through the markets. I mean, how should we read this? Is the system that fragile?
Yeah, absolutely, 100%. And so there were a lot of reports out there that the carry trade unwind was finished. Well, yeah, it was finished for a small part of it, right? And then the Bank of Japan came out right away and said they weren't going to hike rates anymore if until they can figure out how to stabilize the market. When they do, I don't know that they'll be able to figure that out. But it also presents a problem for the Fed cutting rates. And I'm sure they've been working behind the scenes to figure out how to offset this, but with liquidity. But there's two sides to the carry trade. It's the cost of borrowing the yen in massive quantities, which is what the carry trade is, and reinvesting it in much higher yielding assets, dollar based assets. Even just you know borrowing money in yen at 0% and putting it into treasuries at 5%. Well, that arbitrage has been going on since since you could earn even a small spread on it, as long as you could earn enough to offset your cost of hedging the currencies. You're going to do it because you can also leverage it up. So there's all along the spread spectrum between Japanese interest rates, Japan's base lending rate, and the U.S. interest rates. All along that, as that spread widened, more and more of the carry trade got put on. So when Japan narrowed that spread by just whatever, what was it, 0.15% or whatever, and you saw that turmoil that it caused. That didn't unwind the whole carry trade. That just unwound the portion of the carry trade that was put on at the widest spread, right? So you got a trades out there that were put on when the spread was 3%. You know, Fed funds were 3%, and the Bank of Japan's lending rate was 0%. those trades are still on there because you're still earning a very positive carry, and you've leveraged it up if you're a hedge fund.
I think it's just the tip of the iceberg right now. I think more things are going to pop up. But Dave,
100%
uh,
agree.
how do you see precious metals playing out as all of these storms, whether it be geopolitics, fiat money, fiat data? I don't want to say fake data. I'll just say fiat data, fiat statistics, like okay, fake statistics and whatnot, all these things sort of turning into propaganda. They're getting stronger and stronger. They're mudding up, clouding up people's ability to see through all the smoke and mirrors that governments and media are giving us. So, how do you see gold and silver start to perform during the smoke and mirrors?
Well, I mean, I think we've already started to see it, right? We were chatting about it before we started recording. I mean, you've had, gold broke out of a 10 year, was it 10-year, 11-year cup and handle formation, 12-year cup and handle formation. I mean, when it went over 2180, I mean, it shot up. That was a powerful breakout, and it's still in the process of breaking out, and they're fighting it. You're seeing it, especially this week when the COMEX opens. They go in and they price bomb COMEX futures, um, and silver. We were looking at that chart, and that I took it back to 1990. I mean, silver it's in the process of forming that same cup and handle formation that gold broke out of. And if that happens, look out above in silver. But to, to answer your question, I mean, we're already seeing the effects of you know what the global opinion is about the ongoing devaluation of fiat currencies, and that's the Eastern Hemisphere, right? Accumulating gold, and you're there, so you see it firsthand. Accumulating gold hand over fist. They're selling dollar assets, euro assets, and they're converting that into physical gold, particularly the central banks. And so, I mean, I think at some point, and this may be what's part of what's triggering, the U.S.'s um, international military belligerence. I think at some point, and I mean, this has been talked about. It's open. It's out there. I think your Eastern Hemisphere consortium of countries, and plus the BRICS, and I think we're talking about several of the Gulf state OPEC countries, and then your Asian and Asian countries and India. I think they're looking at some point remonetizing gold. And I don't know if that means, just using whatever the currency is that they roll out that's backed by gold, and if they decide to, there's reports out there they're going to back it with some other commodities. It may just be a trade settlement currency. I don't know, but what it's going to do is it's going to shut the West out from trading with the East.
Yeah, that's it's a great point because when you think about it, most of the population, most of the manufacturing, most of the resources, energy resources, whether it's oil, natural gas, it's here, and most of the refining is done here in the East. And if they're going to settle in some type of a currency that has some type of gold backing, I think it's going to be pretty difficult for a dollar to come in to buy things. Or I don't know if I should word it that way, but it's going to get rough.
Well, these consortiums, these alliances that in these countries and central bank, they're doing this because they don't want any more dollars. And the world is flooded with dollars.
Before we head out, can you tell the good people how they can follow you and see more of your work, including the Mining Stock Journal and the Short Sellers Journal?
Sure. So my website is investmentresearchdynamics.com. And there's two links at the top where you can find out more about the Mining Stock Journal and the Short Sellers Journal. And then I'm on Twitter just under my name, Dave Kranzler. So as you know, I'm a pretty active tweeter with zero filter.
Dave Kranzler, I do appreciate your time, and let's catch up in a couple months and see how things are unfolding.
Sounds great, Patrick. Thanks for having me on again.
That was Dave Kranzler sharing his views on precious metals and the economy. To see more of Dave's views and work, please go to www.investmentresearchdynamics.com. If you like this video, please do subscribe, give it a thumbs up, and share. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.